You've probably heard that saying in the financial world, boring is beautiful. Boring businesses, the kind nobody talks about at Sunday barbecues, but which deliver amazing returns for decades. Today we're going to break down Rollins Inc, ROL. Maybe you don't know the name of the holding company, but you certainly know its main brand, Orkin. We're talking about the second largest pest control company in the world. Why spend your time talking about killing cockroaches and termites? 1. It's a crisis-proof industry. 2. The company has profit margins that would make many tech giants jealous. 3. They are an acquisition machine, M&A. In this video, we're going to dive into their business strategy, understand the huge economic moat they have, look at the risks, what the bears are saying, and see how they use their money. Stick with me, because this might be the lesson on competitive advantage you've been looking for. The business model and the industry. Let's start by understanding where Rollins stands. The pest control industry, especially in North America, is very spread out. On one side, we have the giants, Rollins, with about 24% market share in the United States, and Rentokil, which bought Terminix and has about 30%. On the other side, more than 40,000 small regional and local businesses. Rollins mostly operates in the United States, over 90% of its income. But the beauty of the business is that customers keep coming back. The business is split into two main groups. Residential, this makes up about 45% to 65% of their income if we include termite control. Commercial, this is about 35% of their income. The industry has long-term trends helping it. First, climate change. Rising global temperatures make pest breeding seasons longer. More heat means more bugs, means more income. Second, intolerance. Modern consumers who live more in cities and care about health don't put up with pests. The do-it-yourself trend is dying in this industry. People would rather pay a professional than deal with chemicals and bug problems. The economic moat. Now, the core of our idea. Why does Rollins win? Morningstar rates Rollins as a company with a wide competitive advantage. This stands on two main things: cost advantage and intangible assets. The advantage of scale and root density. Pest control is all about how spread out your roots are. Think about it. Rollins has high fixed costs, workers, trucks, training. We guess that fixed costs are 70–80% of their operating expenses. The secret is route density. When Rollins already has a technician serving a street, adding the neighbor as a customer costs almost nothing extra. There's no big extra travel cost. This spreads out the fixed costs and makes profit margins shoot up. The small local competitor can't spread out the costs of training, marketing, and technology, like the BOSS system we'll talk about soon, in the same way Rollins can. The brand and risk aversion. The Orkin brand is like the Band-Aid or Kleenex of the industry in the United States. 50% of new customers sign up with Orkin without even checking prices with competitors. This gives them amazing pricing power. They can pass on price increases without losing customers. In the commercial sector, this is even stronger. Imagine you own a fancy hotel or a food factory. Are you going to hire Joe the Bug Guy to save a few bucks and risk a pest problem that could ruin your reputation? No. You hire Orkin for peace of mind. This is risk aversion leading to loyalty. The efficiency machine. The BOSS system. Many investors only look at how much money a company makes, but Rollins' magic is in its profit margin. In the last 15 years, their operating margin has gone up almost 7 percentage points. How? They put in place and improved a system called BOSS. It's a software that plans routes and manages things. It sounds simple, but it cuts down technicians' driving time by up to 40–50%. Less time driving means more time helping customers, means more money earned per employee. Also, customer retention is 91%, while the industry average is between 82–87%. This happens because they spend a lot on training. They have a huge center in Atlanta. A well-trained technician fixes the problem on the first visit, avoiding the cost of free return visits, the famous callback. Growth strategy. How does Rollins grow? a mix of growing naturally and buying other companies. They are what we call a serial acquirer. They buy 30 to 40 companies every year. Their plan is to buy small, local businesses. Remember route density? They buy a local company's customer list, fire the extra office staff, put the customers on Rollins technicians' routes, and boom, instant profit. But they also make big purchases every 36 months, like Sela in 2025. The risk here? Doing it right, but their track record is perfect. Their way of using money is called excellent. The average return on invested capital, ROIC, over the last 10 years was 23%. That's top-notch. The other side of the coin, bulls versus bears. It's not all sunshine and rainbows. Let's do a bulls versus bears to be fair about this idea. What the optimists, bulls, say. The boss system still has room to grow. Profit margins will keep going up beyond 20%. The market is still very spread out. Half of the companies make less than $50 million. Meaning Rollins has many companies to buy. The Orkin brand is unbeatable at getting sales. What the pessimists, bears, say, competition. Rentokil bought Termix. Now there's a competitor of the same size, with the same scale, fighting for prices and acquisitions. Management. The Rollins family controls over 40% of the shares. They run the company. If they decide something that small shareholders don't like, there's not much to do. Expensive mergers and acquisitions. With more companies wanting to buy small businesses, the price of these acquisitions could go up, lowering the return, ROIC. Financial strength and ESG risks. Financially, the company is very strong. The net debt-EBITDA ratio is only 0.8 times, data from the third quarter of 2025. They have a lot of room to borrow money if a huge buying opportunity comes up. Their interest coverage is 32 times. This means the risk of going bankrupt is almost zero. Risks and uncertainties. The risk rating is medium. The biggest short-term risk is, strangely enough, the weather. Hurricanes or very dry spells can temporarily reduce the insect population. But historically, the company's income grew during the 2008 crisis and the pandemic. Pests don't care about recessions. As for ESG, low risk. The focus is on how they manage products, chemicals. But the company spends a lot on safety and training. Conclusion and verdict. To wrap up our idea about Rollins Inc, ROL, we are looking at a very high-quality company, a market leader with pricing power, a lasting competitive advantage based on size and brand, management that uses money in an excellent way, high ROIC and growing dividends, strong against economic problems. An investor in Rollins isn't looking for the next Nvidia that will go up 1,000% in a year. They are looking for a company that grows money over time, compounder, that will protect their wealth and grow faster than the market average for decades, with low ups and downs in its operations. If you like companies that are predictable, leaders, and profitable, Rollins needs you to study it deeply. What do you think? Does the risk of the controlling family scare you, or do the steady profits speak louder? Let me know in the comments. If this deep dive helped you, please like the video and subscribe to the channel for the next analysis. Thanks so much for watching, and see you next time.